Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video is about using our closed-end fund investment strategy. And honestly, in preparation of this video, I realized I needed to make another video about the current strategy and updates within our portfolio. So let's see. If you want the full methodology regarding our 12 steps to financial freedom, then head to Facebook and check out my page there called Adaptive Perspective, Navigating Finances or Navigate Your Finances. Reminders, it's an unedited video. I make mistakes and yeah, all that's left in because I like raw, transparent, authentic video. So who knows what you'll hear in the background as I film these in my house. It's kind of like the witching hour for our cats. They're ready to be fed, but it's not feeding time. I am not a financial advisor. I'm a financial strategist. I don't speak like the herd. If I walk in limited companies, sometimes I walk alone, and I'm quite okay with that. I'm hoping you're okay with that. So the question I ask is, if I were investing, where would I buy tomorrow? And I'll answer that, but I need to cover some other stuff first. So the talk show guys, the talk show circle plus what I get by email, they're still pushing the ETF bond market as well as the ETF AI. And that's, I mean, if you're into ETFs, that's great. I'm not. But if that's you, that's where you should have been months ago. If you buy now, you're just paying a higher price. So, like I said, that's not my marketscape. So in the closed-end fund world, we can still get those funds cheap if you know where to look, but it's becoming harder to find those. It's becoming harder to find cheap bonds, but we'll get into some of that in a little bit. So if you're investing right now, right? So where should you invest? Kind of comes down to your strategy. I know our strategy. Do you know your strategy? Do you have one? Are you buying low and selling high? Are you dollar cost averaging your funds? Are you investing for the short term, hoping to get as much bang as you can now to draw it out, like pull it all out, or to not invest and then just ride it, either ride the profit or ride the dividend until whenever? Are you building something? And do you know what you're building? What's your end goal? Have you ever heard Warren Buffett say that, oh, if he meows loud, it's okay? Yeah, the cat in the background is hilarious. Uh, Warren Buffett says you want to buy stocks for 66 cents instead of $1. And that's really hard to do, really impossible to do in the general market space, but you can do that in the closed-end fund world. So our strategy is, or our goal, right, is to supplement or fund a retirement through dividends and not selling off our principal investment. We're not selling our portfolio. So that means that we're not using the 4% rule. That means we're not using the 60-40 stock to bond rule that investment circle group talks about. They say a lot of things that don't line up with what we're doing. So it comes down to this. Are you willing to follow the herd and their single stock fool picks? Or are you willing to forge a new path away from what those guys are doing? So on our cork board of things, we use a specific strategy that I'll get to. And we use that strategy unless you have a darn good reason for breaking it, which I can also get to. We want to target monthly dividends unless you just find an amazing deal on a quarterly payer. We look at bonds and senior loans if you can get them cheap. And that's getting harder to do, but you can still find them. I'm sure there's a technical difference out there somewhere that somebody will chime in about. But the keep it simple reasons, or the keep it simple difference between bonds and senior loans. Bonds are fixed rate, senior loans are floating rates, and per some people, they get paid first. But I like the simpler method. Bonds fixed, senior loans floating. Energy infrastructure. Or so where are we looking at? Bonds and senior loans, energy infrastructure. So oil, liquid natural gas, energy transfer, utilities, if you can find them cheap, that's getting harder to do. Think about how much technology has invaded the world, whether you're on that bandwagon or off that bandwagon, everything technology based is oil derived. Uh, if you're investing into Nvidia, all of their products are oil byproducts, right? So if you cancel the oil market, you also cancel technology. Let's see. So we got bond senior loans, energy infrastructure, data and data management. So not like, so it's technology based, but it's not Nvidia, it's not Microsoft, it's who's controlling all the data that everybody else needs in order to function. That new Matthew McConaughey commercial where technology is the new gold rush and your information is the gold. That's pretty fitting. Um, right. So if you can find the gold mine cheap, that's worth a look. You can look at real estate, the real estate investment trust. That's a decent place to be, especially ahead of the hopeful Fed cut. You can look at convertibles, those switching from stocks to bonds if if companies reach the right goals. And then you can also look at preferreds or preferred dividends where the company has to pay those first before the common shares. So that's a lot, and that is streamed down compared to my normal intro. So let's look at, I don't know if y'all can hear the cat meowing in the back, but it's funny. So let's see where the bargains are, and then we'll go from there. So let me share my screen. So this is now the sorted closed-end fund master. The spreadsheet gets updated monthly, and it got updated today. Everything in gray is not in the target area. Anything purple is recommended. Blue is what we own. Green we follow for any number of reasons, and the targets are based upon these metrics. It's a buy alert if the current discount is double or greater than double the historical discount. It's also has to be greater than the 5-year discount. And closed-end funds, without getting into all the different metrics, closed-end funds sell for discounts. Now, the discount is important not so much compared to the rest of the list, but compared to the individual discount for every single fund, or like this individual discount at compared to this fund's historical data. So this is the real value of the company. For any number of reasons, you're able to buy it for this. So I'm looking at, is the existing discount significant as compared to the historical and more recent historical data for the company? And based upon that, I can scale by discount. So yeah, that's 49% off. So it's like paying if your break-even point, so 0.0, not discounted, not premium, then you're for every dollar you spend, you're getting a dollar buy-in. On the other end of a dollar, so if it's a 10% premium, that's like paying $1.10, where it should be just a dollar. And this is like paying 49 cents off. So it's like paying 51 cents for every dollar invested. So if we rank by target, it's actually a shortened list compared to what it has been initially. So all of these, like I went through all this today. So these are our targets. This is the weighting spreadsheet. Current just means we already own it. So all of these funds are significant. Ooh, look at that. This is the final list. You get kind of like a sneak preview. Yeah, raw, authentic video. You get to see my mess up from earlier. So this is our list. So all of these funds are significantly discounted compared to the historical value of the company. So since this is in place, then we can screen by when they pay. Our target, our goal has been to focus on consistent monthly income. And of these, so business development company, rumor has it Aberdeen's going to buy another company, and I don't like we own. So here, this is our portfolio. This is our self-managed closed-end fund only portfolio. And this gets into the video I need to make, but that's an Aberdeen fund. It pays a consistent dividend. You can see our track record. I mean, we never pay premium. You can see our track record. We've adapted our strategy over time. So our strategy now is a little bit different than where we started. The dividend pays consistently. The pricing fluctuates, which you would expect. Their discount, this one, the discount actually does fluctuate. The Aberdeen funds we've owned in the past, we owned AOD and sold it. Let's see, owned AOD and sold it. Discount, and this is just reflective of our buys into AOD, but in general, the discount never changes. Even if the price goes up, the discount never changes. Yeah, we own this one, not happy with how it's run, much like AOD, not happy with how that's run. This fund bought out a company I really enjoyed. And I'm not happy with the buyout. So we've sold 3 Aberdeen funds already, and we kept one. But that being said, they're looking to buy this one, and they bought out and now manage this one. And Aberdeen's a well-known company. They operate a lot of closed-end funds, but in my history with them, and then of what I see online, their discount just never really changes. That's just honestly not like consistent pricing, somewhat consistent dividends. I mean, I would like the discount to close and narrow, right? And then I would expect it to open back. Like I would expect this, but instead it's just constant, and the pricing never really changes. So yeah, I'm not a huge Aberdeen fan. So this fund supposedly being courted by Aberdeen, so we'll probably end up selling this one. This fund has not had a consistent dividend in forever. Since we've bought it, the dividend has decreased. This fund, the discount window is narrowing. It's been as high as 18 to 20%. And the discount window is closing and the price is going up. They should raise their dividend soon. Let's see. No. So then we look at yields. So of what I was saying earlier, strategy-wise, we employ a strategy. So it's got to have a significant discount. We've been targeting monthly payers, and we've been targeting 9% and above. That being said, we would be a fool to ignore the the steepest discount. So we can eliminate these. We'll keep the steep. This one transitioned their portfolio. Um, they went from bonds to mostly real estate and loans, which in advance of the market shift that we're all hoping for. I mean, the Fed hopefully will cut rates a little bit this year. That would be great. I don't think they fixed inflation because that hasn't hit the store yet. Um, I mean, the Fed is saying, oh my gosh, if you annualize our progress over a year, then we've decreased inflation. And my response was, well, I mean, you cook the data anyway. So I don't think inflation really drops below 4% every year in general. So them cooking the numbers and making it work, like making it seem like they're doing a great job on the problem and landscape they created is just kind of par for the course. But it's also they can say inflation's better, but the problem is the pricing at the grocery store says something very different than inflation being normal. So let's see. And why did I delete these? Because, well, here, these fall below 9%. Some are close, but those fall below 9%. These are heavy consumer funds, and they're built like portfolio in a cans, but they're still heaviest in certain areas. Uh, and I've tracked Calamos for a while, and it's tempting, but they're heavy consumer funds, and I still think we have a recession coming. Um, and I can base that on a couple, really just one uh, financial advisory service I pay for, but I can also base that on Facebook Marketplace, which is, yes, I get it, subjective data, but we watch Facebook Marketplace because we like old cars, and it's always interesting to see what people are willing to sell. And currently, there are more classic cars, more toys on Facebook Marketplace than there've been for at least the past 4 to 6 years. So, and more get added daily. I mean, it's amazing what you can scoop on Marketplace right now. And some of those will come down in the next couple months. So, I mean, you're getting a deal right now on somebody's toy, but I think we're going to see more of that. So I'm not, me personally, I don't like the straight consumer route because I think it's too volatile. These are global funds, so they're even more volatile, and consumers just not my ideal place to be, which real estate is consumer. And I don't think it should be utilities or consumer. Um, but when I think of consumer funds, I think of like grills or cars, like something more cyclical, but it could be food. And you could look at ketchup and pickles and mustard. Those are all consumer funds. Um, but categorically, I just think it's too volatile a place outside of more targeted consumer funds like bonds, no, but utilities, yes, energy, real estate, those are more consumers. Those are more that's the part of the consumer market I would rather be in. So this is the short list. And this one makes it because they restructured, they cut the dividend in half. But they restructured when everything was not popular, to be honest. And if the Fed cuts rates, which I think they will cut rates, I don't think they're going to cut 6 times this year. But I think if they cut 0.25%, either beginning of summer or end of summer, it'll spike the market in general. It'll push the market into greed territory again. And it's in greed right now. But there are a lot of people that don't want to be in these funds right now. Closed-end funds is always kind of the small corner of the market. These funds are becoming more well-known. Yeah. So I mean, kind of the not popular place to be but at the same time, a much better place to be in my mind than single stocks. So HFRO, you can read this. I'm not going to read it all to you. Uh, let's see, best place to start. So you get senior loans, uh, global bond fund, almost portfolio in a can, but a good mix, corporate bonds, but all American, and someone who's already switched from bonds into real estate and loans prior to the shift back into real estate investment. So if the Fed cuts rates, then all those talk shows, circle junkies, I call them, all those guys are going to start pushing real estate. And they're not doing it right now. It's like bonds this, bonds this, bonds that, and they're pushing you in certain areas. They're not pushing you here. You can get a crazy return on an investment into a closed-end fund. And all of these are lower than what they've been. I can't testify to that one because we haven't owned it, but and it's a relatively new fund. But all of these are a dollar cost average for us. Um, so let's see. Real, we factor in the places where I would invest in now, me personally. So bonds or senior loans, energy infrastructure, data management, real estate, convertibles, and preferreds. None of these are preferreds, like heavy in preferreds. These at one point had some preferred allotment. Um, but you get senior loans, real estate senior loans, bonds, a mix of all of that stuff, excuse me, or more bond stuff, more technology stuff. So they're all a great buy-in, but where would we invest? If we had the money, which we're gonna sell part of our portfolio, and quite honestly, we're gonna end up investing in, if not all of these, then a lot of these. I mean, the blue ones we're already invested in, but we'll buy more of. This fund, if we, I like to buy things in 50. So I mean, is it going to work if I put it in the right column? We could buy 50 of all of these outside of HGLB because it's just a little bit different. We could buy almost 50 of all of these tomorrow. Um, depending on what we sell and when, we would pick up this one. We're going to end up selling 4 to 5 funds for different reasons, some of which I've talked about in the past, but uh, we'll we've got at least 4 funds earmarked for sale in the next, we'll say, 2 to 3 months. Um, yeah. So pending how the market looks when we sell those funds, this is on the market because you can still get bonds cheap. You can also get bonds this way cheap. The difference is this is global and this is not. I mean, that's a mix of everything, almost everything on the target. I mean, so you got bonds, senior loans, um, bonds, senior loans, energy infrastructure, data management, real estate. I don't know about convertibles and I don't know about preferreds in that, but that's, I mean, gosh, like that's all on the list. Um, but if it were us, where would we invest and why tomorrow? We would invest here. So this is what we already have. This is why I like to know that. But we would invest here. Um, we would be foolish to ignore the crazy discount And gosh, the crazy discounted price. Like I think our current average is close to 9 right now. Right. So 653 times 50 plus, right? Now this is hypothetical, like, so we pick up 50 at what it's priced at right now and add that to what we already have. So you get a total value here. Then you divide that by what the shares would be, and then it drops our overall price of share. Um, and I get it, like the dividend pays less than the standard 9% of what we're going for. It's close. Kind of, that's my, I don't know which cat, but that's a cat scratching in the background. I mean, that's under the 9% route, but at the same time, they lowered the dividend. They've kept it low. They haven't lowered it again. And I think the portfolio will come back. So of what it was paying, now you have top of the food chain or top of the dividend chain for this list, right? And you get it at a stellar price. Let's see if we go back of where we've bought that fund before. Plus last month, say 2 months ago. Last month, smaller window and about $1 more. So we've been waiting for this amount to beef up to either initially make a move, but at the same time, now that we're selling funds, selling individual funds, none of these. Actually, this one's earmarked. It's just the sister version of the one above it. So it's kind of, I mean, that's my doing, but it's doesn't exactly help us to have a duplicate fund when the duplicate fund, the sister fund, does the same exact thing as the other fund. Like if this one had a slightly different strategy and had different companies, and I'm sure at some point in the portfolio it does, but at the same time, it's a pretty close mirror with the other fund. Um, so I digress. Yeah, the cheaper, newer bond fund is tempting, but we would be foolish to ignore this uh, as the most severe discount. It's a great dollar cost average move for us. And me personally, I think the dividend will come back. So I think that's a much shorter video than normal. So hopefully you like the content. Yeah, hopefully you like the content. If you do, consider subscribing to my channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances, where I get into really everything from the budget all the way through retirement of how to make that happen for your dreams. Um, as you face the week, as you face the rest of your life, you are the captain of your ship, right? Whatever you have planned, whatever you have hoped for, waiting for you in the future, none of that will happen unless you make it happen. If you sit back, then the wind will push your boat, it'll push you wherever it wants to go, right? And if that's fine with you, then great, right? But my dreams require us to take a very different route. The quest for property and a hunting business and a retirement that we can pull off early will not come from waiting on the teacher retirement system and waiting for 35 years into the teaching game. It's just not going to happen. So we're taking a different route. And if you want to see what that route involves, then go to Facebook because I talk about it there. As it relates to the market, and I've talked about this before, the single stock investment strategy, I get it, but you end up buying everything and it costs a ton of money and your dividends generally aren't that great. And that's my cat digging into the trash. And he looked at me like, you're over there and I am over here. Um, Closed-end fund market, you get into cheaper. You get access to all of these different funds, a lot of whom that don't pay, a lot of which don't pay dividends. And you get the dividend that you want. If you want a 5% dividend, great. If you want a 13% dividend, well, guess what? That's available right now. Uh, there are some funds that pay steeper dividends. Uh, Not many can maintain them. Let's see. Look, the top dividend on the market right now is a 60% dividend and it's paid semi-annually. That does not fit our investment strategy, quite honestly. That does, we want consistent payments, and I don't want to have to rely on waiting that long. There we go. My sheet got out of order, but it's back ready. So we don't want to wait for those 2 payments a year. We want consistent dividend payments. And if we scatter in some quarterly stuff, then amazing. We have some quarterly payers. We'll keep some quarterly payers, but we're also looking to get rid of a few for reasons that I need to get into on a different video. Otherwise, this one will drag out. So whatever you have planned for the week, I hope it goes well. And for us, spring break is in a week. So, gosh, that'll be amazing. Be like halfway through the semester and it'll be perfect timing. So whatever you have for the week, I hope it goes well. Whatever you have coming up, I hope that goes well. Right? Whatever you're working towards, whatever you're driving your boat to, or piloting your boat towards, you are captaining that ship. So make sure you know where you're going and why. Um, yeah, whatever you got planned, I hope it goes well. Hope you have a great week, and I will catch y'all on another video. Talk to you later. Bye bye.